Welcome to this explainer. Okay, so on May 28th, Costco is dropping an earnings report that Wall Street is essentially treating as a high-stakes test. Now, if you follow retail, you already know Costco is an absolute juggernaut. But right now, this really unique blend of internal friction and aggressive external competition is putting their seemingly invincible business model to the ultimate test. So let's look closely at what's really happening under the hood. Heading into an expected $62 to $64 billion quarter, we have to ask, can Costco defend its premium valuation? I mean, that high price tag investors are willing to pay for its stock. Can it hold up against what's starting to look like a coordinated retail siege? The story heading into this print isn't just about whether Costco beats expectations. It's really about execution, the looming threat of tariffs, and this intense competitor pricing strategy that's squeezing them from literally all sides. To make sense of all this, we're going to break it down into 6 key stages. First, why May 28 matters. Then, the Costco fortress, the Kirkland juggernaut, cracks in the armor, the retail siege, and finally, the Q3 scorecard. Let's get right into it. Section 2, the Costco fortress, and its seemingly unshakable momentum. Just consider this absolutely staggering 89.7% worldwide renewal rate. That's the highest among major U.S. retailers. And why does this matter to you as an investor or someone analyzing the business? Well, because membership fees are essentially pure operating leverage. That means every single incremental fee dollar drops almost entirely to the bottom line as pure profit. It guarantees this massive, highly predictable, recurring revenue base that just hums along, completely independent of merchandise cycles or consumer spending dips. It's a beautiful thing. And that fierce loyalty, it translates directly into relentless growth. Individual memberships are compounding beautifully right now. Just track the climb from 58.8 million in 2023, jumping up to 63.7 million in 2024, and now heading toward a massive 68.3 million by the end of 2025. It's a simple, wildly effective formula. Mid-single-digit comparable sales growth mixed with double-digit membership growth. This compounding effect is exactly what justifies that premium valuation we were just talking about. Now, add to that a surging 22.6% digital comparable sales growth in Q2. That actually accelerated to 23.3% in March. For years, the biggest knock against Costco was that they were kind of dinosaurs in the Amazon age, completely lagging in e-commerce. Well, not anymore. They are finally obliterating that historical lag, and it's driven by a much smoother app experience and the rollout of Costco logistics to handle delivering those big and bulky items right to your front door. Moving on to our next section, the Kirkland juggernaut. This is their ultimate shield. Kirkland's signature generated an absolutely astonishing $90 billion in 2025 sales. To put that into perspective, that's a $15 billion jump compared to 2024. But here's the truly wild part. Costco's in-house brand actually makes more money than global titans like Nike and Coca-Cola. Seriously, think about that the next time you toss a bulk pack of paper towels or that famously cheap hot dog into your cart. The sheer scale here is almost hard to wrap your head around. Kirkland now dominates a massive 28% of Costco's total sales, and it's growing steadily by roughly 1 percentage point every single year. And even if that penetration just creeps up modestly to, say, 30 or 32%, it implies a highly meaningful boost to their overall profit margins. Essentially, the more Kirkland people buy instead of national brands, the more money Costco makes on the exact same cart of groceries. So here's why Kirkland is Costco's absolute secret weapon right now. CEO Ron Vitris uses it as a strategic shield. When import costs on national brands spike because of things like tariffs, for example, Costco just swaps them out for domestically sourced Kirkland items. They completely absorb the tariff pressure, maintain identical or even better quality, and your grocery bill, it stays exactly the same. It protects their core value proposition way better than anyone else in retail. But, no fortress is perfect. Let's look at the cracks in the armor and some of that internal friction. It really hasn't been a flawless year, and there are some real friction points we need to watch. For instance, following a September 2024 fee hike, Costco actually had to throw in a $10 monthly Instacart credit just to keep executive members happy. That is a real, tangible concession, and it eats straight into the new revenue they gained from raising those fees in the first place. Plus, their fiscal 2026 international warehouse openings were slashed from an original target of 35 down to 28 because of supply and construction delays in Spain, which kinda slightly slows down their global expansion narrative. So why did they even need to introduce that Instacart credit? Well, because management noticed a highly specific vulnerability. That September fee increase directly triggered a wave of membership cancellations among younger shoppers. This specific demographic completely balked at the higher upfront cost, and Costco management had to play defense fast to stop the bleeding. And that's exactly why that digital perk was immediately rolled out. Which brings us to the retail siege, the external pressures. Sam's Club just raised their fees on May 1st, and the math here is absolutely critical. Their Premium Plus tier is now $120, while Costco's executive tier sits at $130. Now, for the 2 years prior, Sam's Club was a full $15 cheaper, but now that gap has narrowed to just $5. The optics of this near-tied price point puts immense pressure on lower-income Costco members, whose median household income is around $125,000 compared to Sam's Club's $76,000, to, seriously reconsider where their loyalty lies. Walmart is essentially trapping Costco in a pincer movement right now. They're forcing Costco to fight a highly aggressive two-front war. On one side, Costco has to defend its grocery convenience and delivery against Walmart Plus, which only costs $98 a year and throws in streaming perks. And on the exact same battlefield, they are simultaneously having to defend their core bulk warehouse model against this newly competitive Sam's Club. Looking across the Atlantic front, European deep discounters like Aldi, which now boasts 2,500 stores in the US, by the way, and Lidl are aggressively slashing prices on everyday grocery staples. And sure, while Costco's massive warehouse model is structurally very different from Aldi's small format approach, this aggressive price cutting messes with the consumer's perception of value. Bargain hunters, who usually trust Kirkland for the absolute best deal, might actually start walking into an Aldi instead just to save a few cents on eggs and milk. And looming over all of this is the severe threat of escalating tariffs, particularly on imported electronics, apparel, and home goods. Now, Costco operates on a secret rule. Their gross margins are strictly capped at 14 to 15%. If tariff coverage broadens beyond what Kirkland can simply substitute domestically, Costco faces a really painful lose-lose choice. They either pass the cost right through to the consumer and destroy their famous value mode, or they eat the cost themselves and crush their own margins. All right, let's look at the Q3 scorecard, the big May 28 checkpoint. To keep Wall Street happy and prove this fortress is fully intact, management absolutely has to nail these 5 metrics on earnings day. 1. Earnings per share of at least $495. 2. That 89.5% worldwide renewal rate absolutely cannot drop. They have to prove they've stopped the bleeding with those younger demographics. 3. The market is super hungry to see a massive, non-recurring positive surprise of $500 million to $2 billion in potential tariff refunds. 4. They gotta prove that their digital comp acceleration is actually sustainable at over 20%. And 5. They need clear, positive updates on their international growth momentum in key markets like China, Sweden, and Mexico. So, I'll leave you with this final thought. For long-term followers, Costco offers arguably the cleanest, most defensible business model in modern retail. But when those May 28th numbers drop, we are finally going to find out. Can the Costco fortress hold the line against an industry-wide siege, or are the walls starting to crack? Thanks for joining me on this explainer, and we'll see you next time.